Stocks All Right. Joining me, Nate Peterson, Director of Derivatives Analysis, and Mr. Collin Martin joins alongside as well, Director of Fixed Income Strategist. Afternoon, guys. Collin, let's talk some bonds, because that was the big move this morning. Treasuries tried to push to new highs in price, low in yield compared to the last month, but some pushback, enough to keep that levy from breaking. What do you see when you look at Treasury action this week?
Well, the move lower early on in the day made a lot of sense to us. We have the lingering uncertainty around tariffs, which hopefully we'll get some more clarity tomorrow. And then this morning's numbers were relatively negative. If we look first on the labor market side of the equation, it's a cooling market, not a crumbling market. So I think the key driver of the initial drop was from that ISM manufacturing report, because it had all the characteristics of stagflation that we keep hearing about. Now, why we got the little bounce back, I think there's just so much uncertainty right now. That's what we've seen yesterday and over the past few weeks, where we get a lot of volatility. The trend has been lower, but on a day-to-day basis, we see ups, we see downs. And I think that's going to continue to be the trend until we get more clarity on the tariff front. So when we look at what our range of outcomes is, it's pretty wide right now. If we get some aggressive tariffs, we'll probably see yields fall a little bit, because we see the market being driven more by growth expectations. And I think aggressive tariffs can slow down growth and trade. If we get tariffs that are less aggressive than expected, we'll probably see a little move up in treasury yields to account for the fact that maybe we don't see as much of a slowdown as people are expecting right now.
Bond curves are getting pinched a little bit. That 3-month is proving a little stubborn, even as folks are looking for cuts. Prices paid a little hot in manufacturing. Fed going to have a tough decision in June, because we're knocking off the calendar here, only a couple months away.
I don't think it's going to be a tough decision in June. Our base case hasn't really changed too much. We still think the Fed can cut 1 or 2 more times, but it probably won't come until the second half of the year. Right now, we're seeing a lot of concerns with that soft data.
Like June second half?
ISM report. Second half. Well, June's still first half. So we're expecting sometime later than that.
Okay.
So I don't think June's really on the table right now. We need to see the hard data really start to crumble. And that'd mean a reacceleration in inflation to levels that are concerning for the Fed, and probably a big uptick in the unemployment rate. That's really not our outlook right now. We think we'll probably see some gradual loosening, but I don't think we'll see that impact by June. Okay.
Thanks for that clarification. So, all right, market may not be getting that cut too soon, Nate, but the data, if they hold in, I wonder if that's an okay thing. I don't think anybody's rushing for emergency cuts. Hopefully we don't get there. What do you think of the action in stocks today, Nate?
Well, I mean, on the bullish side, you could say that we did a successful retest of the March 13th low yesterday. Tentative price action today, understandably so. On the bullish side, you could say that we have bullish seasonality. We've got earnings coming up, in 2 weeks here. Maybe that can at least provide, some excuse to get some kind of a relief rally, and maybe especially within tech and the AI complex. But, even if that's a retest, like on the S&P, for example, we did our 10% down. We ran back up to the 200 SMA, and we got rejected there and went back and retested. So that right there is called a throwback. A pullback. It's a bearish confirmation. So the retest held, that's great. Let's see where we are by the end of the week. But even if we get the technicals in order, even if we get a blanket tariff that's less than expected, I think there's still going to there's that uncertainty word again in terms of what the impact is going to be to the consumer. And, look, the consumer's been doing really well, because the housing market and the stock market has basically been sitting around all-time highs, if not making new all-time highs, back-to-back 20-plus years. We just took 10% down, over the past 6 weeks here. We've seen some evidence that they are pulling back, and I've seen some estimates for, if Trump were to go with a 20% blanket tariff, that could impact households by anywhere from $2,000 to $4,200. And the consumer is what's going to be driving, that GDP growth, which is going to translate into the bottom line for corporate earnings, which has allowed us to basically remain at this 20 PE. So we still have this hard data to get through, like when we get into the months of May and June, so we can actually see what the impact is of these potential tariffs should they come on board.
Okay, yeah, that's an interesting stat, interesting number. Everyone trying to play pin the tail on the donkey for the impact. Hopefully we'll get some evidence soon enough, but obviously we know sentiment is soured, so maybe some reasoning for why. In terms of the data that's coming up, what's the priority, Collin, in your mind? Obviously, I mean, jobs crucial with employment. We do get some commentary from Jerome Powell. How high frequency do you think is his thought process right now if things go really rough in the next couple of days? Because, I mean, today it looked like the bond market was really trying to push that manufacturing into like a recessionary style rally.
Right.
That's a good way to
go ahead,
phrase
Collin.
it. High
Sorry.
frequency. Oh, sorry about that, Nate. I think that they are paying attention to the data, of course, and they're not going to make a big decision. Obviously, if they cut rates, that sends a message. So they're going to need to see some sort of trend that warrants that rate cut. But I think it does really it falls to the labor market right now, because the last thing the Fed wants to do is see that unemployment rate tick up the way we saw it tick up, last summer, which resulted in that September rate cut. So I think that this week's number will be important. If we get a weak number, that won't necessarily result in the Fed preemptively acting in May or June, but it's one piece of the puzzle, and the labor market is something that the Fed will be paying very close attention to.
Tell me about how you're reading the data this week, Nate, and what you're looking for around these numbers.
Yeah, I think Collin's spot on. Dual mandate, we know inflation is going to be a question mark there. So therefore, if the Fed is going to be cutting rates, you got to go to the labor market. I think 250K is that high water mark for initial claims. Thankfully, those have been behaving very well, around 220K. JOLTS was a little bit soft today, but still above pre-pandemic levels. So if that unemployment rate were to tick up, Collin's right, we're going to need to see a couple tick ups there and some more evidence that there, is some distress in the labor market, I think, in order for the Fed to, get more dovish here on the scene, because, they still want to see what is going to be the impact of those tariffs on inflation.
Facts. True. Thank you, gentlemen.